everyone, and welcome to this Wealth Management Fast Chat. I'm David Armstrong, the Executive Director of Content at wealthmanagement.com. And today I'm joined by John Miller, who is the Head and Chief Investment Officer of the High Yield Municipal Credit Team at First Eagle Investments. John, thanks very much for joining us.
Thank you very much for having me.
So the results of your fund this year so far have been impressive. I think Morningstar is considered the #1 fund in the high yield municipal bond space, both in terms of performance and flows. What are you guys doing, and how have you been able to produce those results in comparison to some of the other managers in the space?
Yeah, thank you. Well, there are some big picture themes that are long lasting, and there are also some individual credits and individual credit selection that we've done, which is already working out successfully so far. From a big picture point of view, we've quickly assembled a highly experienced small elite team of investment professionals with expertise in high yield municipals, and work very collaboratively together and really focus all of our energies, which average between 15 to 30 years of experience per person, focus all of our energies on really this one product, and this having been a relatively moderately sized product, so that each bond allocation, and sometimes these bond allocations are scarce, each good trade idea can move the needle more in a smaller base of assets. In addition, the fund does not have any leverage. I think that's been beneficial. It doesn't have any defaulted bonds. And with the timing of the launch of this new strategy, the yields have been relatively high starting in January of 2024. So we've been investing up new assets in a relatively higher yielding environment and performing credit selection, which has been more modest in things like Puerto Rico restructured bonds, modest in tobacco securitization bonds. We've been heavier in things like healthcare, charter schools, colleges, land secured bonds, some industrial development revenue bonds, and transportation projects like the Brightline train. So far, many of those selections have been working out well in terms of specific credit allocations in the fund.
Fantastic. Are you still seeing opportunities in high yield municipal bonds? And if so, where are those opportunities? And how would you compare those to the taxable high yield corporate bond market?
Sure. Well, first of all, we are seeing a lot of opportunities because interest rates, as I mentioned, municipal yields started the year at among the highest levels in the last 15 or 16 years. But those interest rates have actually risen on a year-to-date basis. In addition, new issue supply is up approximately 37% versus the same time period last year. That includes both investment-grade munis and high-yield municipals in terms of the increase in new issue supply. Then the credit spreads are also an important component of defining the opportunity set. And those credit spreads have been actually very diverse in the sense of some of the larger, most liquid bond issues are at narrower spreads, where some of the selections that we have made have been at wider credit spreads. And that has, I think, will continue to be the case going forward. As it compares to corporate high yield, municipal high yield is a subset of municipal bonds. So the correlations are more more closely correlated to the municipal bond market. And I think that bodes well in terms of lower volatility and more resistant to the ups and downs of the economic cycle. And the scarcity of the tax exemption is also supportive. Corporate high yield, meanwhile, is more correlated to things like GDP growth in the S&P 500, and default rates can be more volatile, and they're more sensitive to the 10-year Treasury yield levels. So I think it's a different asset class, even though it has high yield in the name. It's really more municipal versus the corporate side.
John, you've been doing this for a long time. You have a lot of insights into the municipal bond space. You could have brought these talents to any asset manager out there. What drew you to First Eagle?
Many different factors. First of all, in getting to know First Eagle, I really value the culture, and the people. The size of the firm is the right size in that it's a meaningful enough of a size at $138 billion in assets under management to be very relevant to many investors and financial advisors. But it's also not so big that municipals can't have a meaningful impact on the firm's growth and offerings going forward. And to that end, I was very much attracted to the aspect of First Eagle not having a municipal bond department and being able to build something from scratch to really put my experience to work to make an imprint on an asset manager wanting to perform at a high level in a asset class like municipal high yield. So I found the environment to be very supportive, and also having a little bit of that entrepreneurial spirit, even though it's a fully built out, long-standing history as far as First Eagle as a company.
That's fantastic. And it's been working out so far. As we noted, FEHIX is considered the #1 municipal bond fund at the moment in high yield, according to Morningstar, year to date. So, John, thanks very much for joining us. Really appreciate it for this Wealth Management Fast Chat.
Thank you very much, David.